Hello, and welcome to the latest episode of the Advice Guru podcast. Well, I'm delighted today to be joined by someone who actually I've been trying to get on as a guest for quite a while, but he's been a very busy man. So today I have the founder and CEO at AdviseWise and the managing director at Age Partnership, who is, of course, Jonathan Thirkill. Hello, Jonathan.
Hi, Stuart. Thanks for having me on, and glad we've finally made this work in the diaries.
Yeah, that's absolutely spot on because I've seen your name around a lot over the years, but we've never met and never sort of, events or on calls or anything. So it's really nice to put a name to a face and have a chat.
Likewise, yeah, nice to meet you.
Yeah. So that was the biggest job title I think I've ever read out on podcasts. So how do you find the time to do all of that?
Yeah, no, it's challenging. Originally I was just doing the CEO of AdviseWise and founded the business. But it's probably worth some context. Age Partnership was founded by my father, and I've worked in the business quite a long time. I actually started there when I was 16. I'm now 32, so I've had 50% of my life in some way involved in the extra lease market, which I think is a unique
Uh, yeah.
of for me. And also, it wouldn't even be legal now, 16. I remember turning up on day one and people thinking, who's this? Is it work experience? Because I looked really young. And I sort of joined the business literally at the bottom, even though my dad founded the company as a web developer. And just, I was really passionate about
Okay.
development at the time, started building the website for Age. And then I actually went on to run the web team, sort of as a sort of 21-year-old, which was great. I really sort of enjoyed that period. But ultimately, I love the market, but I wanted to do more. I felt like I was in the shadows of sort of my father. I ended up setting up my own businesses outside of the later life industry,
Okay.
and realized very quickly that running your own business is very, very challenging. So I sort of got schooled pretty quickly and went, okay, this is actually harder than I expected. And then the opportunity, came around with sort of setting up AdviseWise. I felt, that we could provide better technology into the industry to sort of facilitate hopefully better advice for customers. And we founded AdviseWise and launched it in 2019. We launched the Mortgage Club a week before COVID, so that was fairly challenging. There's always something, but I think that's what
Yeah.
this industry is like. And then during that period, I became a non-exec director at Age Partnership, sort of applying my learnings from AdviseWise over at Age and also at Pure, which is the sort of lender side. But then post the mini budget, sort of back into 2023 now, it became obvious that the Age Partnership, the market, we don't need to go over old ground, changed very quickly. And I was uniquely placed because I spent 50% of my life in the business. And I knew so much from, yes, I hadn't been in the business sort of on the front line, but I had that knowledge about how the process worked. So I ended up jumping into Age as managing director, supporting the business transitioning as sort of lending volumes dropped 60%. And, really difficult time for the
Gee.
business, difficult
Yeah.
time for me, really difficult time for the market. But I learned quite a lot, fascinating sort of time. I probably learned 5 years worth of business knowledge in 5 months. Lots of difficult decisions, and yeah. So now I'm sort of sat across the businesses, and we're sort of thinking about how my role really is thinking about how we grow the market from here. We've got, I think we've got some great businesses. We've got a great industry. Consumers need the product. I think we're well positioned with AdviseWise and Age Partnership and Pure to sort of deliver good outcomes for customers. But the bit for me now is how do we start to think about growing the market, because it's, the levels of lending are low. If you added up all the funders and said, what do you all want to lend, you probably get about 4 or 5 times the size of the market. So there's real opportunity for growth, I think, and it's just thinking about how we do that.
Yeah, great. Well, that's a brilliant introduction, Jonathan. And there's quite a lot to unpick there. So, God, where do I start? So, I didn't realize that you'd started at age 16 and you're
Yeah.
now only 32. So, you've achieved a lot in your 16 years. So, what would you say out of that has been your proudest moment?
Well, that's interesting. I think it's having started at the bottom. I know that sounds a bit cliche, but there's never any ego for me, and there isn't to this day.
Yeah,
About, I understand the position that I'm very fortunate in terms of my dad founding Age Partnership,
yeah,
but I feel like I'm proud of the fact that I feel like I've earned my place
yeah,
round the table.
yeah,
And I'm proud of sort of if you look back over the time, the improvements we made in the website, trying to educate customers, trying to make sure they understand the product and trying to grow commercial volumes at the same time. I'm proud that we've ultimately helped quite a lot of people. I like to think I've had an important role in helping loads of people unlock equity from their homes, get the right outcome. It's great. When you hear those, I've listened to the calls. I like to listen to the calls in the business.
okay, yeah,
We have this completion call, which is basically our team ringing the customer to say funds are due on this date. And that calls, it's actually emotional, because the relief you hear in their voice, the
yeah,
fund, whatever the amount is going to be released. It's going to be within your bank account within 48 hours, whatever it might be. The relief that you hear in their
yeah,
voice, because ultimately, and there's a lot of needs based customers currently, they're thankful that we've been able to provide a solution that's helped them through their sort of difficult time, or it's allowed them to, the aspirational side, it's allowed to do something with their life. You only get one life, right? They've been able to do something that they really wanted to do, didn't have the means to do it. They've got money in the home. We've unlocked it. They're going to spend time with their grandchildren. They've only got one shot at life. So yeah, I think it comes back to that customer and just helping people ultimately.
yeah, yeah. No, absolutely. And I love the idea of a completion call and phrasing it that. Yeah, I still advise, so I still have those calls, and they are lovely moments. I think you've hit the nail on the head. Even in the last 18 months, those calls have become relief for the
Mm.
clients, a lot of them, because they are needs based, and you have enabled them to solve a problem. You've worked with them to solve an issue, whether that be a mortgage coming to an end, whether it's helping family out, etc. But no, I love that. So let's take you back then. So you've been doing the age partnership role for about 18, 20 months now.
Yeah,
So
something like that.
that clearly you took over a very, very tough time for the market. A lot of the podcasts have focused on the tough times for the market. So I don't think we should rehash that conversation with you and with your experience of it. Because I think you and I had a chat before we started recording, and we're both in a very positive place about how we're feeling about the market, how it's going this year, and projects that you guys are working on. So talk to me and the audience about that. Why are you feeling so positive at the moment, and what are you working on?
The underlying need for the product exists. People still need equity release. Look at the market. We're recording this the sort of 7 days after Trump tariff liberation day, and the
Yeah,
uncertainty with customers is still really, really high. So I think, deep down, there's still enough customers to go to grow this market. We just need to think about how we educate and grow awareness. In terms of advise wise and age, we're looking at how we unlock the mortgage market. So excitingly, we've just signed an exclusive partnership with one of the biggest mortgage sourcing tools in the UK. I think they have around 16 to 17,000 mortgage advisors. So you can probably work out who that is, but I don't want to spoil the launch event for the
come on,
marketing
give us
team.
the exclusive.
Yeah.
Take name.
But it's coming very soon, coming imminently.
Okay,
But
right.
ultimately, the need is there. So
Yeah,
people need the product, people need money. And I think there's the way the markets are going with the regulator and the direction of travel, with us trying to educate mortgage advisors, wealth advisors around holistic advice, and partnering up with other advisors, and start thinking about how we triage, can start to think about growing the market. Although TV, by the way, would be fantastic. Aspirationally, we
yeah,
want to get the market back on TV. We do want to do that. but it's got to work. It's got to be viable. So we talked about this before. TV does grow the market, and I think we hear it from IFAs who get those referrals through, where they've said, "Oh, I've seen Age Partnership on TV, or I've seen someone else, Aviva, maybe on TV." But ultimately, people don't see a TV advert and immediately go on and take out an extra lease plan. As much as we'd love that to happen, those customers aren't ready yet. They need educating. They need to understand. The need needs to deepen. They need to understand because it's a big considered purchase. I would not expect, I don't think, even if we think about ourselves, I'm obviously not old enough to buy an extra lease product, but if, buying a car, for example, I don't just go and buy a car. It takes time. I research it. I do all that. It's the same with actually. So I think TV is great because it will grow the market, but it will take time, and therefore, people and the industry investing in that will take time to get people comfortable. So we need to think differently. Going back to these referrals and how we grow the market. You're doing some great stuff with education with customers. I think that's really important. But then it's how we educate the advisors in the first place so they start thinking about opening it up.
Yeah, no, it's all really good points, and I'm particularly interested in your project and signing of the deal with a company who deals with 16 to 17,000 mortgage advisors. So tell me, how did that come about? Is it because the TV advertising just isn't within the budget? Is it working smarter? Yeah, how did that come about?
I think it's been a slow burn. We've been speaking to them for quite a while, and I mean, totally honest, I think it's a perfect. Things have aligned, stars have aligned,
Okay.
both in the mortgage market, and this idea of a single advisor being able to do everything. I mean, not do everything, but be able to deal with any customer and deliver the right outcome. That has been driven by the regulator. It's been driven by the market. It's been driven by the markets. You think about Amy and doing stuff with the actual lease council and starting to think about this. It's becoming more forefront in people's minds, and therefore the mortgage market is starting to think about, okay, extra lease, £2 billion market, mortgage market, 300 billion or whatever the number is. I don't know. It's a lot bigger, put it that way. And actually, I think there's around 50 billion in mortgages written who are for over 55-year-olds. So there's a whole load of people there that are taking out mortgages where they're now thinking consumer duty world, how do we make sure we're delivering the right outcome? So I think it's a bit of a stars have aligned, and the way that the markets are moving are opening up these opportunities. And I think it's really exciting for us as an actual lease market because I do think if people take a second to review the customer all the way through the journey, triage properly, have the right conversations, that some customers will find themselves on an ERM. And also, there's quite a lot of flexibility now. We look at the interest service products. It is fantastic that you can service that interest, take out an extra lease plan. But if circumstances change and you don't want to commit to payments, assuming you don't break the terms and conditions of your plan, you're not going to get your home repossessed. And I think that security for a lot of people is really important. You could have taken out a fixed term interest only mortgage in 2020 and had all the disposable income in the world rather than an ERM product. But look what happened with interest rates. Look what happened with the cost of living crisis. That money might have been very quickly eroded, and you could potentially be in a very, very different situation now. Whereas actually, if you're taking out an ERM, and service the interest, you would have that flexibility on your side. Now, clearly, every customer is different, and an interest service product might be the right for quite a lot of them. So I'm not suggesting that everyone needs an ERM with interest service. What I'm suggesting is it should be considered, and we should be looking at that. And advisors across the industry, every advisor should be having those conversations. It sort of it pains me that you could get a different outcome depending on which advisor you go to. I think
Yeah,
ultimately that, in my mind,
yeah,
you need to, whatever advisor you go to, they will do the best job with the options available, not because they are an expert in a product and try and fit them. And I think that the regulators made that point, and I'm totally in agreement with that. And that's
yeah.
the area that we need to try and solve.
Makes 100% sense. I think I've noticed in the last 6 months because Advice Guru, we're talking to networks like you're talking to networks and mortgage networks, and they seem a lot more open to working in collaboration with other companies in a different industry to theirs. And you put that down to consumer duty earlier on. Do you think it's consumer duty led? Do you think that there's more of the lifetime mortgage senior people who had to leave that market um, because there weren't enough jobs in it, that they've moved into the residential market and are thinking, oh, you're missing a trick here. What has been the trigger?
I don't know. I think consumer duty does play a role because ultimately, it's making everyone think twice around the advice they're giving. I think the FCA's multi-firm review that they did in 2023
Yeah.
around product bias has got people thinking. And even if you're in the mortgage market, you've got to be looking at the takeaways in that and applying it in your industry. There's a lot of customers who in the mortgage market are sort of getting product transfers, and it's sort of extend and pretend, that sort of concept. They don't have a repayment vehicle potentially. They continue to pay an interest only. They've got repossession risk. Those advisors need to be thinking about an ERM product, in my opinion. It might not be right for everyone, but all my sort of ask is that people should be considering it. And the other side is, and we do this at Age Partnership, is if someone comes to an actually specialist, we need to be considering a mortgage where there's enough disposable income. It goes both ways. What I'm saying, doesn't just mean we're expecting it from that side. Same with wealth advisors who are looking at the clients and their requirements. Property wealth is huge. The amount of money, and how can you possibly advise someone without considering their property and whether or not equity release could be an option, or an interest only mortgage? There's lots of things moving. So it's I think that's what's ultimately driving it.
Yeah, you're right. It's really interesting though that we're talking about mortgage networks and sourcing companies being really interested in the later life market, whereas perhaps they weren't, and for whatever reason that is. Do you think that now is a good time for the advisors out there, the individual advisors who listen to the podcast, to actually redo their contact with local mortgage advisors, with local IFAs, because they might have tried that a year ago, 18 months ago. And from what you're saying, perhaps that market wasn't ready to speak to us then, or perhaps we didn't need to make the effort to speak to them then because we had a
Yep.
booming market.
Yep.
So it is now the time for individual advisors to get out there again.
Definitely. They should absolutely be contacting those mortgage advisors, and it's symbiotic, by the way. They should have those referral contacts in place anyway, because inevitably they might get an actual leads customer who, when they do the income and expenditure, realize that there's quite a bit of disposable income, and actually, potentially a mortgage might be a better option. So they should have those relationships anyway, to be passing them back and having a look and making sure. And you know what, it might be that the customer says, you know what, I don't want the repossession risk. Okay, that's fine. We can understand that, and we can advise based on those preferences and what their objectives are ultimately. But yes, they should be having those conversations. And like I said, it's a two-way street, and I think that having those referral partnerships in is good for both parties, and ultimately, going back to what I'm talking about, deliver better outcomes for customers, which is what we're all here to do ultimately at the end of the day.
Yeah, absolutely spot on. And I think that's a really important thing that perhaps advisors out there are going, oh, it's a little bit quiet at the moment. Market isn't where it used to be. I'm not getting inquiries in. I can't afford to buy leads because I haven't got the turnover. So yeah, maybe that's just a top tip for advisors listening, that just get out there to the old companies that you have spoken to in the past. You may have got a brush off from them then, but that their network might not have been talking to them about needing to be holistic. Completely bizarrely, while we've been on the phone, while we've been on the call, I've had one of my mortgage broker firms who I refer to, cases I can't do, and vice versa, have just come through to me said, Mr. won't say his name, has just completed. I've just sent you £324. I'd forgotten about that lead. I'd forgotten about that client. He has now had his needs fulfilled because I couldn't help, and that company's paid me, and that company's chuffed to bits that one of my leads came off, so they're going to want to send more leads to me, and that's just the micro, isn't it, Jonathan? And I think,
It's the win, a
yeah,
win. You've got a win for the customer, a win for yourself, a win for that mortgage advisor. There, that's a 9 pointer if you like, and we should be looking for them because that is, and it's how we grow the market as well. Because ultimately, like I talked about, 50, 50 billion in mortgages on over 55s on the other side. So there is a real opportunity, if we do this right, to actually grow the market. Just, people absolutely, and having those triage processes in place, and having the right conversations with customers so they can identify it, and educating the mortgage advisors to be doing the same thing, and educating the wealth advisors to be doing the same thing, is how we'll grow the market. And eventually we'll get back on TV once the time's right.
got to be done. Got to be done. Okay, so my
Got to be
final
done.
question to you then, Jonathan, is, and I've started asking this question at the end of each podcast, so you probably know what's coming. So, if we're recording another podcast with you in a year's time, what would you like to have been? What would you like to say in a year's time that you're proudest of the year 25, 26 created for you as a business?
Well, I'm obviously hopeful that the partnership that we talked about earlier delivers on its objectives, which is ultimately to educate mortgage advisors around equity release, give them the ability to compare and contrast those products as part of their everyday mortgage advising journey for customers. And we see some customers who potentially didn't fit a mortgage. Maybe they didn't pass affordability. Rather than being turned away in the mortgage market, or being given an inferior product, or being pushed to take out something that maybe they can't afford, we see some of those customers come over to an ERM, and maybe they'll service the interest through some of these great interest service products that we have in the market, and ultimately will deliver growth in the market, because that's where we want to be. We want to grow the market. That is our goal. We absolutely want to grow the market. We don't want to be here in another year and have a market start with two. I think it'll take time. I think we need to look at advisor productivity and growing the advisor numbers. There's lots of stuff. There's so many things. We could talk for an hour about all the things we need to do. But if we can start seeing some customers move from that mortgage world into the ER world, and get better outcomes, even if it's just one customer with a better outcome, I'll end the year and think we've done a good thing. Hopefully it'll be a lot more than one, and we'll really start to change the game in terms of people getting better outcomes. And as I talked about, a single advisor, you're not getting a different outcome depending on which advisor you go to. That's got to be the goal. And if we grow the market through doing those initiatives, that is what a good year looks like for us.
Fabulous. Jonathan Thirkill, thank you very much indeed.
Thank you.